Good afternoon, everyone, and welcome to the latest in our series of Professional Advisors Working Lunches, with today's sponsor, Baillie Gifford. I'm Andrew O'Kelly with Professional Advisor, and I shall be your host for today. Central banks have been desperately trying to battle disinflationary forces for many years. How worried should we be if they finally succeed? Inflation has a powerful impact on the value of money over time, so today's savers need to think carefully about their future needs, an income stream they can rely upon for decades to come. And with bond yields rising from historical lows, which assets can combat rising inflation? With dividends decimated by a crisis that's accelerated some seismic societal shifts, which companies are best positioned to face the challenges of tomorrow? Well, to look at the future and to discuss how investors can source a reliable and sustainable stream of income that will last a lifetime, we're joined today by Baillie Gifford's Clients Department Director, Paul Roberts. And viewing life through the lens of the advisor and their clients, we welcome back Unique Financial Planning's Managing Director, Philip Martin. Just before we start today's session, I'm just going to run briefly through the obligatory housekeeping notes. Your microphones and cameras are currently switched off, and if they're not, I can see one or two of you with cameras on. We'd most appreciate it if you turn them off. It just ensures that there's no background noise so the speakers can be heard more clearly. Thank you, sir. Appreciate that. For those of you who have either a nickname or simply your Christian name against your screen icon, please do look out for the chat function, which you'll probably find on the screen at the bottom there, because you'll probably be receiving a message from my colleague Joe just to establish who you are. This isn't a big brother thing, it's simply so that we can ensure that you receive your CPD certificate after the event. Today's session is going to be broken into 3 sections. So as well as the usual Q&A at the end of the session, please do feel free to ask questions of our speakers in the discussion sessions that will break up the 3 sections. And you can post questions for Paul and Philip in the chat function, which, as I've said, you'll find at the bottom of your screen. And whether it's during one of the discussion sessions or at the end, I promise we will endeavour to address all of your questions in the time that we have allocated. I should also inform you that this session's being recorded, and we'll send you a link to the recording by tomorrow. And so do please feel free to share this around with your colleagues at work. As usual, today's working lunch will qualify for 1 hour of CPD, and we'll also be sending you your proof of attendance along with the link to the recording of the session by tomorrow. So now in traditional CPD style, here are today's learning objectives. Paul and Philip will take a look at where to find reliable income in today's challenging markets. They'll look at ways to address the impact of inflation in the long term. And finally, they'll discuss the benefits of a multi-asset approach in providing a core income solution. Okay, so that's the housekeeping out of the way. Let's move on to the main part of the event. And let me hand you over to Baillie Gifford's Clients Department Director, Paul Roberts. Afternoon, Paul.
Thank you, Andrew, and good afternoon, everybody else. Andrew's already touched on the background noise issue. I feel like I'm sitting in a building site here in our office, so if you can't quite hear me over the sound of a pneumatic drill, then please let me know and I'll try and speak up. I'm really pleased to have this chance to speak to you all. It seems to me we've got a collective responsibility to help individuals secure their retirement. And when we think about income drawdown, that essentially means we've got one main objective: to not let them run out of money. Now that's a big challenge as we're all living longer, and investment income to fund that retirement is increasingly hard to come by. Though bond yields have been low for many years, and 2020 showed how dividend income can be completely unreliable in the face of an economic shock. So ultimately the question I'm hoping to answer today is, how can we give confidence to your clients that they can rely on that investment income to provide the lifetime of income they need? And we've been thinking about this question at Baillie Gifford, and we think our multi-asset income fund can provide a really compelling option as a core part of your clients' income drawdown solutions. Now, it's all very good me telling you what a great investment strategy is. If it doesn't fit into your client proposition, or your clients can't easily understand how it may work for them, so I'll be looking to fill it to keep me right on that. Please do the same with your questions and comments. As Andrew said, we'd be glad to take them as we go in the breaks between each session. So I will come on to give you our solution to two specific challenges. The first is how to provide that reliable income in today's market. And the second is how to protect that income against the power of inflation over time. And the second of those is particularly important when we think about longevity risk in retirement. But first, I thought it'd be useful to spend at least a few minutes explaining why Baillie Gifford is well placed to help with that challenge. Now, you may well know Baillie Gifford as a leading high growth equity investor, whether that's through Scottish Mortgage, the managed fund, or just reading various news articles about the stellar returns that Tesla has provided for our clients recently. But it may be somewhat surprising that we think the traits that make us a good growth investor also differentiate our approach to income investing. And having a growth mindset is actually a big part of that, particularly thinking about longevity risk. So at Baillie Gifford, everything we do is long-term. We're long-term fundamental investors. We think that it's only over the long term that you can make fundamental judgments about investments and not be dictated by short-term market movements. And by fundamental, I mean we do forward-looking analysis, imagining what the future holds. So what if rather than what is. And we're truly active. We have a huge global universe that can truly add value for clients. And when it comes to providing that reliable and resilient income, being active and stock selection is absolutely crucial in providing that. So we launched our multi-asset income fund nearly 3 years ago, having thought best how to meet this growing need for reliable income and how to incorporate those Baillie Gifford characteristics within them. And we're aware some of our peers tweaked their existing total return strategies to deliver a higher yield. But we decided to go back to basics and design the solution around the problem. So all elements of the fund are focused on delivering that long-term income stream. We took the best bits of many of our existing strategies. So our successful global income growth strategy, which has a very strong peer group record, forms the equity model for the fund. And many of the decision makers from our highly rated bond and multi-asset strategies are directly involved. So what that means is we've got a fund that brings together the best bits of Baillie Gifford's stock selection expertise, its experience in managing broad multi-asset portfolios, and the corporate culture, which is focused on the long term, which is aligned to our clients' needs. So we set the specific objectives of the fund to meet the needs of a client who wants that core income solution they can rely on over time. So specifically, we're trying to deliver an attractive and resilient monthly income stream and to preserve the real value of income and capital over time. So to grow income and capital to maintain its purchasing power. Practically, what we're aiming to do is deliver the highest level of income, which we think is able to deliver consistently and sustainably over time. And importantly, it's tomorrow's capital which supports that tomorrow's income. So we do need to think carefully about preserving the real value of capital and not be lulled into the trap of delivering the highest yield today. So first technical challenge, I will try and share a slide with you. So this is what the fund looks like in practice. And our research has shown that a multi-asset strategy is best placed to meet those long-term objectives. On this slide, hopefully you can see we're invested in 9 broad asset classes, categorized into 3 main areas. So we invest in equities, so they can provide both good levels of income and real growth, so growing ahead of inflation. We invest in real assets, such as property and infrastructure, and these have fantastic characteristics for a long-term income stream, often delivering good levels of yield, but also growing that in line with inflation linkages, or indeed growth ahead of that. And then a range of fixed income asset classes that can help to boost today's yield, whilst not necessarily providing the growth. So this broad opportunity set has the benefits of diversification. So it lowers the volatility of both income and capital and gives us flexibility to manage the fund to deal with different economic scenarios. As I'm showing it here, we think over the long term, having around about a third in each of those broad asset classes of equities, real assets and fixed income gives us the best chance of meeting those long-term objectives. And our research and analysis and modeling backs that up. So with that, I will stop sharing that and hand to Philip and sort of ask the question, Philip, how do you think this would work in a client portfolio? And what are the burning questions for you as to whether this could work over time?
Yeah, so I think, well, thank you, Paul. Obviously, that's a very helpful start. I mean, I think the key for us is to understand how this fits into client portfolios in accumulation phases and also in drawdown. So both pre and post extracting cash out, and how you would see the fund operating with potentially other assets to better match people's risk appetite. So where would you be classifying it if it were held as a single holding by a client? Because that then gives an indication of how you would dial up and dial down risk according to people on either side.
Yeah, and so I guess is that we think it's a very valuable core solution, given that we're aiming to deliver that very resilient income. We think that, well, currently the yield on the fund is around 3.5%. Over time, we think a sustainable level is probably a maximum of 4, around about 4%. So if you can deliver 4% reliably and maintain the real value of that income and capital, and that's a very compelling proposition. Clearly, some people won't need that much income today, and maybe they want to boost their long-term growth with equities. Others might want to supplement that with an allocation to higher yielding bonds or infrastructure, whatever it may be. But it feels to us as though if you can rely on that bit in the middle, then it's a really compelling kind of core portfolio that will deliver pretty much roughly what it says it will do, and then you can adapt that and blend it with different things.
Okay, and I guess the second question that flows out of that, I mean, you indicated that your broad asset allocation strategy would have a third in each of the buckets between equities and real assets and fixed interest. Do you see that changing over time, or is that pretty much a laid down split between those three different distributions?
So that comes from modeling very long-term behavior of asset classes, looking at the biggest history we can, and optimizing is slightly the wrong word, but looking at the interaction, the correlations of those. And we think that broadly gives us the best chance of maximizing those long-term objectives. And it's important to have that balance of assets that can provide growth, both in income and capital. So we'll always want some equities there, but maximizing today's income, so you'll always have some fixed income there. So whether it would vary significantly from that a third, possibly not. We do repeat that exercise every year just to make sure we're moving with change in opportunity sets. But I suspect that is a pretty good indication over the very long term of the best way to meet that. Obviously, over a shorter time frame, we have much more flexibility. We can.
Moving tactically, you'd be moving tactically around, but you're not anticipating here that there would be any shift to 80-10-10 as a fundamental shift in long-term thinking. That's regarded as your sustainable long-term broad split. It could change to 40-30, 40-30-30, I guess. But
yeah, exactly. We give some rough rules of thumb in terms of how much we might have in each, and we might say up to, say, 60% equities in a very, very positive scenario. The challenge is that balance of current income versus long-term income. So in that scenario, we need to find other assets to make up the income. So I think you've always got that trade-off between today's income and tomorrow's income and the capital objective. So not that it heavily constrains you, but it means that over time, we think this rough balance is about right for those objectives.
Understood. Thank you. Nothing else from me at this stage. Don't know if you want to press on.
Sure. Okay. So the second section, as you will, is looking at reliable income. So how can we find this reliable income over time? And the past year has demonstrated how difficult that is. And if you've relied on many of the traditional high-yielding markets, such as the UK, you've had a pretty rude awakening. I'll share a slide again, which just shows that in practice. So here you can see in the UK and France, another high-yielding market, and we're probably all pretty aware of this, dividends were cut pretty severely in the crisis last year. So over 2020, dividends were around about 50% lower compared to the previous year. Now, our global approach helped. It was slightly more resilient, but even in that context, you were down about 15% in the year. So You may have invested in a typical 60-40 fund, 60% equities, 40% bonds, and perhaps that cushioned the blow a little bit because bond yields fell pretty heavily, some capital growth, equities recovered a bit. But I'd be pretty nervous about that strategy from here. Bond yields are most likely to rise from historic lows, and we've already seen that early this year with a bit of a shock leading to negative returns. So the big question is, if you can't rely on maybe a strategy that's worked well in the past, what can you do? Well, our answer is to go global and look to the future. So we already saw that global was a bit more resilient, and there were markets that actually delivered growth in income, such as China. But our observation is many of the companies that were forced to cut dividends in the crisis were already operating in some challenged sectors. We think you need to apply the mindset that Baillie Gifford is synonymous with, which is looking forward, which are the companies of tomorrow. So on this slide, some examples that many companies in a traditional income portfolio are those companies which require significant amounts of investment to grow.
Yes.
Plant or equipment, telecommunications.
We're all watching a webcast with Baillie Gifford.
They face this challenge between
there's the webinar on
earnings and investing for the future. And often they take on large amounts of debt on their balance sheet to do that. So we think this is a pretty risky exercise. However, we prefer companies which we describe as capital light, ones that can grow and invest quickly and adapt and generate significant levels of free cash flow to support progressive dividend models. And having a global opportunity set is hugely beneficial in this regard. There's around about 4,000 dividend paying companies that we think are investable. And that means we can find future growth companies such as B3, a stock exchange in Brazil, or TSMC, a chip maker in Taiwan. And Microsoft is a great example of what this looks like in practice. So having faced some pretty competitive threats, it's adapted to a cloud-based offering and now has a really well-entrenched position, generating significant free cash flow, which supports its dividend. And the challenge for many income investors is that these companies often don't have the highest yield. So shown in the blue bars on this chart, you'll see that 10 years ago, Microsoft yielded about 2%. And if we compare that to RWE, as shown in orange, so this is the German utility, which yielded 7% and was seen by many as a blue chip income generator, you can see the folly in trusting in a high yield stock. So when analyzed properly, RWE was shown to be powered by dirty coal and nuclear. And when the regulatory pressures came, it was forced to invest with significant upfront investment. And that slashed its free cash flow. Ultimately, its dividends fell, and no surprise to us, its dividend was stopped completely. Now, meanwhile, Microsoft has steadily been growing its dividend over those 10 years. So today, for every £100 you invested, it now delivers £7 worth of income. So you can see over time, these companies often deliver the highest level of long-term income. So over that 10-year period, Microsoft delivered twice as much income return as RWE. And the real bonus, as you see in the bottom line of the table, is that our clients benefit from that long-term investment approach with a significant capital return as well. So over the long term, these sorts of companies can provide the highest level of income through growth, but they can also prove really resilient in a crisis. So this slide is showing the top 10 dividend payers in the UK market, and only one of them grew its dividend in the last 5 years. In our equity income sleeve of the Multi-Asset Income Fund, all but one of them grew their dividend in the last 5 years, and indeed through the very challenging period of 2020. So the proof is in the pudding. By investing in these long-term growth companies, you can not only provide a good long-term income stream, but also one that will weather an economic storm. Now, well, as a multi-asset fund, we're not just limited to equities. So we have a fantastically broad opportunity set. And I think infrastructure is a particularly interesting asset class. It's particularly helpful in the fund meeting its objectives. Infrastructure investments often deliver levels of income that are similar to the best parts of the fixed income market. So let's say 3 to 5% yield, but also growing that income, often with an inflation linkage over the long term. So we invest about 20% of the fund in a mixture of renewables, PFI and diversified infrastructure projects, and regulated utilities. Now, as we saw with RWE, you still have to be very careful within that to select the right securities. But a recent purchase of ours, WEC, is a good contrasting example. So this is one of the biggest energy generators in the US, based in Wisconsin. It's been on the right side of the energy transition. So it's been reducing coal and investing in renewable energies, which helps boost its future earnings. Crucially, it has a very supportive regulator. So one that understands that balance between keeping the lights on today, but investing in the future. And as a result, it can generate a return on equity close to 10%. And that allows it to support its long-term dividend payments. And understanding these nuances is the key to determining whether WEC or RWE is going to provide that long-term income when they are seemingly two similar companies. So despite a very challenging backdrop, we've been finding lots of interesting ideas across different asset classes. So another recent example of an equity purchase is Silicon Motion. So another Taiwanese company, one that focuses on the solid state drives that you find in your phones or your notebooks. It's a founder-led company with a strong engineering culture, so it's been able to quickly adapt to the changing backdrop. It has a conservative dividend policy, and we think, therefore, offers a great example of the capital-light business that we can invest in. We think it's in a prime position to take the best part of the transition to the cloud, and over time, that will support future growth in its dividend progression. Another example is the property asset class. Now, you might well think that property is particularly challenged, and certainly that's been our observation of the retail market and the high street more recently. But that's thrown up some really interesting ideas in, say, the areas of logistics, which support our online purchases. So a recent purchase for us was CTP, one of the leading developers of logistics property in Central and Eastern Europe, based in the Czech Republic. So this might be outside the comfort zone of many a traditional property investor based in emerging markets. The founder, again, retains significant control. But for us, it's representative of exactly the type of property company we're attracted to. Today, it doesn't have the highest yield, around about 2.5%, but it has a very conservative strategy, and we think, therefore, it's very resilient. But we also expect that dividend to grow and at least double in the next 5 years. So a fantastic long-term income growth opportunity. And then investing in many of these lower yielding but high growing assets allows us to invest in those higher yielding assets, as I mentioned earlier. And emerging markets are obviously a good place to find that. A recent addition to the fund is Egypt, for example. Now, this is an example of a country that's worked through many challenges. It's not without challenges. It's a well-managed economy, but it offers a double-digit yield. And we think that massively overstates the risks that our clients are taking by investing in that country. So a perfect example of how we can balance that current and future income requirements. So having this global universe allows us to invest across a diverse range of income-paying securities to provide that reliable income today and to grow it over time. And with that, I'll come back to you, Philip, for the questions you may have.
Sure. So I've got one question in since we completed the first section, Paul. So we maybe just pick it up just now, actually, because it's related to asset allocation. So John Orton has asked, how do you see the asset allocation changing if inflation were to increase over time, drift upwards? And what would the impact be on performance and potential future yields for each of the three buckets, in essence?
Yeah, well, that's a fantastic question, John, and effectively steals the whole of my last section of this presentation. So perhaps one we can come back to and I can talk through in a bit more detail. It's definitely the topic at the moment. Yeah. Okay,
so one thing that I think is worth picking up, at this stage from your description of the fund, is this mixing between the yield that the assets themselves are generating, the overall income that's being thrown off by the fund. How are you explaining that in the way that you're describing the fund to the outside market? Because they're obviously different things.
Yeah, and I think, well, something like Microsoft actually paints a very clear picture, we hope, is that yield and income are not the same over a period of time. Yield is today's income divided by its price.
Yeah.
And clearly, if you have a yield today, if the price goes down, you can keep generating that high level of income, but high level of yield, but your income is not growing. One of our observations of our kind of what we consider to be our peer group in the multi-asset universe is that if we look at last year, many of the funds that delivered the highest level of income return actually had the worst capital performance. So it's a sort of it's a mirage that if you invest in very high yielding things today, you really need to think about what that looks like over the long term. I say that Microsoft example is a great one. If you can show that income grows over time, then that's very positive. Now you need to grow your capital, otherwise you run away with an increasingly difficult yield. So that's why we have the dual objectives, to make sure that our aspirations on capital and income match each other over time.
Okay, and I guess the other question that interests me is about the real assets and the ability to access both property and infrastructure. Now, both of those asset classes have some challenges when held within our mutual fund structure, an open-ended mutual fund structure. And obviously many of the bigger retail presences are wrapped in closed-ended vehicles like investment trusts. So what limitations do you have around the sorts of things that you can buy and hold in a mutual fund for those asset classes? And do you regard yourself as genuinely participating in those asset classes, or are you having to do it in and through proxies, like the example you gave of the logistics property company in Eastern Europe?
Yeah, I mean, it's a very good question. So I'll start with the second of those, perhaps. I think time frame is important here. So, you know, that is a listed company, and many of these things are the regulated utility the same. So in the short term, there's some equity risk in there. But over the long term, these often have the characteristics of the long-term asset class. So if you're investing in a REIT, which is how we access most of our property, real estate investment trust, you know, the tax structure there effectively means that they always pay out their rental yield. So what you're investing in is rental yields over time. You know, do you expect rents in this part of your property structure to go through? And effectively, that's what underpins property valuations. So we think with a sensibly long time frame, you're getting the benefits of these long-term assets, the kind of the illiquidity premium that you get with those. You're paying that away with some short-term volatility, but in a diversified portfolio, that's not a problem. So in a way, that answers the first question, which is that, you know, we're typically investing in listed vehicles, whether that's a closed-end fund or a listed company, such as, you know, a regulated utility company. So a mixture of those. And then we think about liquidity at the overall fund level. So that's all daily traded. It doesn't really impact us. We're a daily traded fund, and we have to think very carefully about that. We have a limited budget to invest in slightly less regularly traded assets, but we're not typically using that because I think we can find these attractive long-term characteristics in regularly traded securities. Okay.
And I guess the last question I had on this part of your presentation is really to do with the whole attractiveness of multi-asset. I mean, I think for our client base, I absolutely get it as a core part of the portfolio. I like the single fund structure as a core part of a portfolio that's then added to beyond that, particularly one that's giving multiple asset classes. Do you find resistance by UK investors who still have a very UK focus, particularly as we're going through a recovery phase, and want to overburden their portfolio with things that they see and understand better than something that offers the diversification of investing in other assets in different countries, and perhaps even with currency exposure as well?
Yeah, well, I mean, starting with the equity side of the story, you know, our observation is that the UK equity income sector is still much larger than the global equity income sector. And, you know, that has proved to be quite a challenging place to be. So our global equity income funds have performed very well, both in their own peer group, but also relative to the UK. But there's still the most amount of money in UK equity income funds. So the proof is in the pudding there, I think, is that yes, there's certainly a sort of, you go with what you know. But, you know, again, over the past number of years, the UK has been one of the highest yielded markets, and that's not perhaps been the worst thing. But what's been shown more recently is that was kind of always a bit of a folly and it couldn't last. So, you know, we've hit that sort of inflection point, if you like. I guess more broadly, it's the question as to whether, you know, delegating to us the responsibility of building a multi-asset portfolio. We think there's lots of benefits to that. And we've got the expertise and access to lots of different asset classes. Or if you build that yourself, and then many people, as I mentioned earlier, you know, relied on the kind of classic 60-40 allocation, which again has done very well in the past. The question is whether from here you're likely to get the same outcome. And, you know, we're thinking very hard about that question. We've got the flexibility to deal with it. So we think there's a lot of benefit in sort of outsourcing that kind of portfolio construction to a multi-asset manager such as us. Everyone will have their own approach.
Yeah, understood. Okay, well, we have a question in our back pocket after your inflation section. So over to you.
Perfect, thank you. Well, yes. So the big topic of inflation, it's a current topic, but equally this is one of the most important long-term questions. So the crisis showed how difficult it was to deliver reliable income in the short term. But over the long term, inflation is the biggest kind of risk to your income stream. I'm putting a few numbers around it. £1 today at the Bank of England's inflation target of 2% will lose its value in half of its value in real terms in 35 years. And if inflation is just a little bit higher at 3%, it only takes 25 years to halve its real value. These are precisely the timeframes which people in retirement need to think about. So that shows how important it is to hold those assets which can provide some level of growth. Again, I'll just share a quick screen to show what that looks like in practice. So this is a simple illustrative example, but it shows that in our experience, if we hold equities that can provide real growth in both income and capital over time, they can provide the highest level of income. If we hold real assets that can match inflation in terms of their income producing, they'll provide a constant level of real income. And of course, holding fixed income assets such as high yield bonds, over time that income is eroded by inflation. But importantly, holding the ones that can grow income allows you to hold the higher ones, as I mentioned earlier, and create that balance between today's income and tomorrow's income. So I think it's just worth bearing that in mind, that you need that kind of long-term growth mindset to deliver a sustainable growing level of income over time. Now, even in a steady state of say 2 to 3% inflation will cause you some questions in the long term, but what of the potential for a higher period of inflation? All the market noises around that at the moment. And the Federal Reserve in the US has signaled its intention to move to targeting average inflation. So having experienced a prolonged period of low inflation, will now tolerate a period of high inflation. And of course, the cynic might argue that it's got an incentive to do that, having built up a lot of debt on its balance sheet that it wants to inflate away. So, in the UK, the Bank of England hasn't been so explicit, but one of my investment colleagues used to work there as an economist, and he assures me they'll be thinking something pretty similar. So we're expecting here a global approach to tolerating slightly higher inflation than we have in the past. Now, to be clear, I'm talking here about the difference between short-term and long-term inflation. Now, this year, we're almost certainly going to see a spike in inflation. In many ways, it's a recovery from last year. Activities resuming, commodity prices have bounced. But there's still plenty of slack in the economy. A lot of this exuberance seems to be fueled by the liquidity that's been pumped into the market. So we think there's reasons that could start to fall away again. However, if we look beyond that, there are structural reasons why inflation has been depressed for a long time, but some of those may finally be coming to an end. So globalization is a good example of that, where globalization seems to be stalling, if not reversing. Demographics is another reason. So our aging populations are now starting to spend away that savings glut, which has been depressing yields and inflation. And then the climate agenda. So we're reaching a point where there's probably going to be a sustained period of investment in the infrastructure needed to make this transition to renewable energy, which again should boost kind of spending growth and inflation. So we can make an argument that high inflation is more likely now than it has been at any time in the past 30 years. So what would we do about it? Well, again, let me share. So I clicked on the wrong button, I almost left the meeting. Share my screen again. So what would you do in an inflation scenario? Well, not unsurprisingly, we'd probably be reducing high-grade, long-duration bonds. They have a high sensitivity to interest rate rises, particularly those longer-dated ones. And we've seen that earlier this year already, where bond yields have been rising. Now, high-yield debt has less sensitivity to interest rate rises, typically higher coupons to cushion that rising yields. And if inflation is due to good, strong economic performance, then corporate balance sheets tend to do quite well. So we can make a good case for holding at least some high yield in the portfolio. And emerging market debt, we think, can still perform okay in certain circumstances. So if inflation is largely contained to developed markets, and particularly if the US looks through that inflation and keeps policy rates low, the dollar being therefore weak, we think emerging markets can perform pretty well in that scenario. So we can make a structural and a cyclical case for holding emerging markets in the portfolio. But then we turn to these assets that can provide those more long-term growth characteristics. So real assets such as infrastructure and property, as I mentioned, often have some direct inflation linkages. So infrastructure projects often built into their contracts, commercial property leases, or just the general growth characteristics that many of these companies are able to do by investing for the future. So a reasonable exposure to infrastructure and property would be appropriate. And equities can perform pretty well through rising inflationary scenarios. Now that might seem slightly counterintuitive at the moment, where we're seeing some of the high growth stocks selling off in a response to possibly higher yields. But importantly, if you pick the right companies that have pricing power, they can perform particularly well in an inflationary scenario. So for example, expect your can of Coke to keep creeping up in price over time, but you'll keep buying it because it tastes so delicious. So, identifying those companies that can effectively adapt in an inflationary environment makes a lot of sense. And history tells us that. If we look at periods of rising inflation in the past, equities were one of the strongest performers through those periods. So, this gives a good indication of the type of skew that we would have in the portfolio over time. So, part of the question is, where are we today? Well, the biggest debate we have on the investment team is this difficult decision between long-term inflation and interest rates and where it will go. It's a very live debate. We don't have all the answers, so I can't give you a strong probability. But what I can say is we've been starting to position the portfolio more in an inflationary direction. You'll recall our strategic asset allocation was around about a third in each of those main building blocks. And you'll see here, we're not far away from that at the moment. We're pretty optimistic about the outlook for equities. We've got a strong rebound in activity coming through, restrictions are easing, interest rates remain low, and the fiscal spending should support them for a while. So we're finding plenty of new ideas. But having said that, valuations have come a long way, so we don't want to have too much more than our strategic asset allocation at the moment. And in fact, we've been gradually trimming some more of those long-term growth equities into ones that can provide a bit more diversification. So we've been investing in some miners of commodities, particularly precious metals like gold, which will provide a bit more diversification and a hedge against that inflationary environment. If we turn on the flip side in fixed income, we've had virtually zero in developed market government bonds for some time now. Not the place to find income, and recently yields have been rising, so capital values have been falling. So that's been helpful to the fund to avoid that. We were recently attracted to investment grade going back to the middle of last year. There was a big sell-off in March and the asset class became very attractive. So we'd added quite substantially at that point. But we think that's largely played out now. We've been reducing that position over time. But we do still think that high yield credit is attractive. Many of the reasons I've already touched on. So the lower interest rate sensitivity is helpful. Corporate balance sheets are still pretty well supported by the rebound in economic activity. So we're comfortable having a reasonable weighted high yield. But we think the best opportunity for a long-term income portfolio is in emerging market bonds. There you're still getting very attractive levels of yield in a global context of 4 to 5% or even higher when you look at, say, Egypt in double digits. And we can make a structural case for that to continue. So we're pretty enthused by emerging markets and as you can see, have around 20% in total across the portfolio. And then finally, the real assets, the biggest exposure there being to infrastructure. And I've already touched on many of the characteristics why that is the case. We're pretty enthused by the outlook. We think there's going to be continued spending on infrastructure projects, the green energy revolution. And actually, our infrastructure holdings were largely unaffected by the pandemic, so they offer exceptional income resilience. We can't say the same about property. It did have some challenges, so we have less enthusiasm for property on a relative basis, although more recently valuations have been more attractive. We've been adding in places, and particularly in those areas where we think there are long-term opportunities like logistics or CTP, as I mentioned. So slightly of inflationary tilt to that kind of long-term asset allocation that we mentioned. Lots of exciting ideas, and we think this portfolio is set up well for the years ahead. And by that, I mean a return to something what we describe as close to normal. So we've gone through a very severe stress test. We think the fund can now deliver that long-term growing income and capital stream. And having been through that stress test, we think it held up pretty well. You know, the income was largely unaffected, a small drop, but that's not surprising in a very challenging circumstance. But capital growth was very good. So we've come through the test well, and income resilience was good, and returns were good. So the diversification benefits of that multi-asset approach have been helpful. The flexible asset allocation has been helpful. But we think the biggest contributor has come from that security selection. So it's that Baillie Gifford mindset, identifying the best income payers of tomorrow. And with that, Philip, I hope that answered the inflationary question in terms of what we might do, but we can build on that if required.
Yeah, it did. I mean, one question, just looking at that final chart about how you're currently positioned, this is just really a question out of interest. In the emerging market component of it, which has got about 20%, to what extent has how each country has responded to its own issues around COVID and the pandemic and the likely cost of clear up and the likely effect on balance sheets and so on and so forth, to what extent has that changed your view on different countries and the relative yields that each of them offer? Would it be the same list now as it was 18 months ago pre-pandemic, ordered in the same way, or not?
Well, it's a very good question, and I suspect the answer would be not entirely. So there are countries that have struggled. So Brazil, for example, where
Brazil would be the obvious example, wouldn't it?
Yeah, so there are definitely countries where we've trimmed, where they're struggling to get it under control. In many ways, that often points to this kind of the political framework or the kind of how managed the country is. So it's a window into the structural factors that we're more interested in. So can these countries kind of continue to perform well over time? In emerging markets, they've all got their issues. They're all working through them, and many of them have made fantastic steps in the last number of years in terms of their kind of economic management, their institutions, their policy around that. But you get big fluctuations in political cycles, and Brazil is one of the challenging examples of that, and Turkey's another. So I think the short answer would be we are active, so we will be changing in response to those things. But in many ways, we're looking for the kind of the more longer term structural stories. So often that won't be massively impacted by those shorter term events.
Yeah, no, understand. And the fund itself, how long has the fund been going now, and what size has it got to?
So we launched it in August 2018, so it's almost 3 years old. It's almost 100 million, so it's gradually grown over that time. So, hopefully a good point for people to consider how it's done over that time, and hopefully in August this year we'll hit the 100 million mark as well.
And does it sit with both an income share class and an accumulation share class for those that don't want to take the income on an emerging basis?
Yeah, absolutely, it does. Yeah, and we do have a number of investors in the accumulation share class, perhaps thinking over time, and sort of it helps in the volatility management of an accumulation strategy, and then switch on the income when you need it. So yes, it does have those.
Okay, very good. I'm not sure, Andrew, are there any more questions that have come in from the...
At this point, no, there are not. So I just wanted to thank the two of you for a really insightful, informative session. And I thought that perhaps what we might do is, to start with, is just go back over those learning objectives, and so we can see what we've discussed so far. Then we can think about Q&A. So Philip and Paul have explored where to find reliable income in today's challenging markets. They've discussed ways to address the impact of inflation in the long term. And then finally, they've outlined the benefits of a multi-asset approach in providing a core income solution. And as we've said, there is 15 minutes if we need it for Q&A. Be very happy to take any of your questions. But since I'm not seeing any right now, perhaps we could ask if there's, Philip, if you've got any other questions you might like to ask, and perhaps in that time, some others might want to post some questions on the Q&A, on the chat.
Yeah, we talk quite a lot about asset allocation, Paul. Actually, it'd be quite helpful to understand how you're positioning this in with individual advice firms that may already have asset allocation approaches for themselves. So if this is going to sit as a core part of that offering, would you be trying to match their existing asset allocation against the one that the fund's currently holding and then seeing the differences? Or are people taking a more fundamental approach and saying this forms 75% of my holding and I'm going to build out from it?
Well, I suspect there's a kind of a long-term and a short-term answer to that. So we haven't necessarily had any direct conversations, but our research has shown that that long-term asset allocation we think can, meet those objectives. So it might be a good starting point in that broad sense. But I think more the latter is, we think this can do a really good job as a core solution. So, let us take that kind of allocation and do what we will with it over time. And then, match it to individual clients' needs with the bits that you might want to bolt onto that. So like you say, it might be 70% this plus or minus, I guess you've got equities at one end and cash or more fixed income at the other, depending on risk tolerance and income needs. So we think it can work really well in that scenario. If we do our job, which we really think we can, which is to deliver a very sustainable and, reliable stream of income with that capital growth over time, it really gives you that flexibility to build a proposition around it.
And I guess the extension to that is that if you see this being particularly attractive for people that are in decumulation, then obviously one of the things it's coming up against as an alternative way to do that is annuitization. So have you done any modeling around how long a fund set up in this way would be expected to deliver better value before the pickup from mortality would make some sense to start annuitizing, in effect, if you get my drift?
Well, I mean, there's a question for individuals about mortality risk and how that varies. But if you take the starting point of an annuity, so I think if you buy a level annuity at the age of 60 today, you probably get around 4%-ish income. And so we're not far off that. And so, if we can deliver even close to what we're saying we will in 35 years' time, we'll be delivering not just 4% income or £4 today, it will be that times by inflation, which is nearly double as we saw before. So, and you'll have your capital left at the end. So relative to an annuity, unless you really need the guarantee of an income that an annuity provides, the value comparison is night and day. And perhaps maybe one of the most sensible ways to think about this is if you invest in this fund today, and then at some point in the future, 75, 80, wherever it is, you have a better idea about the absolute requirement of spending in the future, you can annuitize part of that. You've still got your capital left to do that. You commit to an annuity today, that's it. It's a one-time decision, and it's really the longevity risk that you're battling against. So the annuity comparison, I think, is a fabulous starting point. Individual needs will vary depending on how much you need the guarantee. But purely from a return perspective, we think this is a fantastic, investment option relative to that annuity stream.
The point is when it starts to morph from one to the other, I guess.
Yeah, exactly.
We have had one question in from Simon Strapp, which is an interesting question. He said the investment outlook at present is broadly positive as we emerge from the effects of COVID. But what are your views of possible bumps in the road ahead? His example that he gives is the Chinese and possible actions in the South China Sea, by which I think he means saber rattling in the South China Sea, I think is what he's alluding to there. So how have you factored that into a kind of wider macroeconomic view?
Yeah,
for the house.
I suppose there's a process point which says, as a multi-asset fund, particularly exposed to, economic fluctuations, we are constantly thinking about the various scenarios and your risk return of that. So I don't think that kind of very specific China scenario is one of those scenarios, but we are thinking about possible bumps in the road and, what can challenge our main assumptions. So, we carry out an exercise on a formal basis every 6 months, which looks at various scenarios. Actually, the China one is probably wrapped into a bigger one. So that is, China against Japan in the South China Sea, or China's intellectual property rights with the US, or is it a currency manipulator? And China's the central view of these things. But, what we're looking at here is a period where, there are always events such as this. Look over the last 3 or 5 years, trade wars, currency wars, those have all had an impact on valuations. But ultimately what matters is growth and what's fiscal monetary policy able to deal with that. So we think from here, the fiscal spending, particularly in the US, is really going to keep markets propped up. You're likely to see monetary policy, tapered away in the opposite direction, and we'll see how markets react to that. But there's enough signs that that kind of growth outlook, economic momentum should continue. But valuations have come a long way. And one of the reasons I mentioned we're not really wanting to be overweight equities at this point in time is for precisely that point. There will be bumps in the road. There definitely will be. It's just weighing up how much you're being paid for those risks. At the moment, we think it's relatively balanced.
Okay.
Well, I've got a sorry. I've got a couple more questions coming in, but do please finish off.
Well, I was just about to do much the same, Andrew. I was about to say, you wait for questions all day and they come along like 23 buses. They're coming in at a rate of knots now. But a good question in from Duncan, which is about exchange rate risk, actually. So he specifically mentioned, you've highlighted Egypt and Czechoslovakia. Is there exchange rate exposure in the fund, or is it all hedged out?
So typically we're looking to provide a sterling stream of income. So we do hedge the majority of that currency exposure. Emerging markets is actually one area where we think part of the return potential is the appreciation of currencies over time. So our starting point is not to hedge that. And so the example of Egypt, we wouldn't necessarily be hedging it. Part of it is the currency exposure. So predominantly the fund is currency hedged, but where we specifically want to take currency risk, we will.
Yeah. Okay, and that will change over time. The proportion,
yes,
yeah, will change over time.
But it's usually a relatively small proportion. So we're confident we can deliver a pretty reliable sterling stream of income. The return potential from certain currencies is worth taking at various points. Yeah,
a little bit of extra risk, understood. One question we've had come through, I think you did actually pick up during the presentation, but it's worthwhile you just perhaps restating it if it maybe just hasn't been clear. So Crispin has asked, how do you access the infrastructure asset class? Is it direct equity exposure, or are you using closed-ended vehicles holding the underlying real assets? And I think
and so it's all indirect, but through a combination of companies that are listed entities, so such as regulated utilities or infrastructure companies, or closed-end vehicles that hold those portfolios. Some of those are specific PFI structures. Some of them are diversified infrastructure funds, such as 3i or other names you might be familiar with. And a lot of the renewable energy companies are in that kind of closed-end structure. So a combination of listed companies and listed closed-end vehicles, but none of it is direct infrastructure. So we have no issues with liquidity.
Okay. And I guess, from my perspective, sorry, Andrew, I was going to say just the last question I would have is, what would you say is the most compelling reason for why a fund to throw off income for clients is best constructed in the way that this is?
Well, I mean, the biggest challenge I think you face is that, if you can match your income requirements with the income generation from your assets, you're not exposed to market risk or sequencing risk or whatever you want to call it. And one of the things that, a 60-40 fund has performed very well in the past because assets have gone up, and that's been great. But you've got a big challenge there that if you get, negative returns, particularly prolonged periods of that, and you're drawing down capital from it, that sequence of returns risk becomes a meaningful thing. And this isn't necessarily about what the total return will be. This is just the order of those returns. So in a way, you're just kind of taking a gamble on that strategy working. So we think that taking the natural income from investments, if you need it over a prolonged period of time, is absolutely the safest way to deliver that. So that's what I would say, is that this fund is sort of the solution matches the problem. And the problem is to deliver a reliable stream of income from your investments. So if those investments deliver a reliable stream of income, then hey presto. So we think that's the most efficient and effective way to meet that objective.
Excellent. Andrew, over to you.
Yes, Paul, I've got a couple that have come in to me. One advisor is asking, with many of IFAs, such as myself, outsourcing investment decisions and using multi-asset or discretionary options, where does this fund sit from a risk perspective, and any plans to have similar offerings of different risks, as risk does vary between different clients?
Yeah, absolutely. So this is, if you take sort of a DT or the de facto, I think it's a risk 5. It's in the middle of the range.
Yeah.
So it is the core kind of multi-asset income producing solution. We've definitely thought about different options. There's definitely an argument that some clients will want to generate a high level of income and gradually draw down capital, maybe take more volatility. At present, we've had one fund which we think fits in the middle, and a range of income funds that we can then tag onto that to construct a solution. So we've got our global income growth fund. If you need slightly less income but more long-term growth, then allocate a bit to that. So that's our starting point, but certainly over time, we'd be delighted if, if there's demand for similar products that have slightly different objectives, then we'd be really keen to hear about that. So please, those kind of questions are great, and let us know what will work for you, because, we can tweak the parameters of this to meet certain objectives. But at the moment, we think this just sort of sits neatly in the middle and is the best starting point for us, if that makes sense.
Okay, thank you, Paul. Well, there's an invitation for everybody listening. If there's other products you need, you know who to talk to. One final question, as I see it at the moment. What impact, Paul, is the strength of the pound against the dollar and euro having on the fund? And do you see the pound continuing to strengthen?
Well, so slightly coming back to our currency question, we hedge out any kind of dollar euro currency risk in the fund. So the short answer is that has no direct impact on the fund. There's a second question there about sterling. One of the reasons why sterling's done a bit better, we've taken away some of the question marks about the UK's future with the Brexit referendum. In the short term, when there was a significant advantage to investing in the US, for example, with high yields, and that yield differential was narrowed in the past year. So that's one of the reasons why sterling has caught up a bit. So I think our outlook on the pound is pretty probably neutral from here. I don't think we see a strong reason for any of those things to necessarily continue. Most of the uncertainty has been taken away, but there's a definite question mark about the UK's competitiveness in this sort of post-Brexit world. So not massively strong reasons for the pound to continue strengthening. But I don't want to get too deeply into that debate because there's lots of different angles to it. So the main point being is the fund is hedged and relatively unexposed to that.
Okay, Paul, that's great. Now, as far as I can see, I think we've fulfilled our promise to ask all of your questions to Paul and Philip. So thank you, everybody, for your questions, and thank you to our two speakers for what I think you'll agree has been a really valuable session. Before we sign off, just let me remind you of some dates for your diary over the coming month. In 2 weeks' time, on the 26th of May, we're back with our next working lunch, where Schroders' Gillian Hepburn will continue the Schroders theme of intergenerational wealth when she explores the ever-growing opportunity and need for financial advice amongst divorcees. And in June, we'll be bringing you 2 consecutive days of working lunches hosted by the newly named Fintel Group. On the 16th of June, Simply Biz will discuss ways to manage the growth of an advisor business through reducing risk and cost, while at the same time enhancing your client solutions. And on the following day, the 17th of June, Fintel's bespoke consulting division, Signature, we're going to take a look at the key elements driving your business in a post-COVID world. And they're going to take a deep dive into aspects such as intergenerational wealth, ESG investments, assessing suitability and retirement income within your centralized investment proposition. So that's it for today's session. All that remains is for me to thank Paul and Philip for a really first-class session, but let me reserve the bulk of our thanks for you, our readers, for your company this lunchtime. I trust that you found this helpful and worthwhile. And if you did, then there's maybe a chance we'll look forward to seeing you again in a couple of weeks' time. Goodbye.